playing offense with CREDE, and as part of the CREDE world, we wanted to bring Malcolm Davies on, who's an old friend and professional colleague, and the senior partner and founder of Way Capital. Way Capital is a debt and equity provider and broker. They are connected throughout the country with numerous banks, debt funds, family offices, and private equity funds. And they've been a go-to resource for us and many of our clients over the years, both at Way Capital and then with Malcolm before and some of the other firms that he worked with before becoming a founder of his own company. So, Malcolm, welcome.
Thanks for having me, Colby. I'm looking forward to this.
Sure. Well, maybe give us a little bit of the story of Malcolm himself and Way, and what really got you to have the passion to not just start a business, but frankly, I watch you and your team live on airplanes for clients and, attending next to almost every event imaginable next to man. And, in these hardest of times, I've seen you closing deals left and right. So, is there any secret sauce or things you can tell people out there today of what you're seeing or what's different with Way?
Sure. I think, look, the big part, common thread and common theme is I believe, and we believe at Way, that relationships are everything. And the only way to really capture strength in relationships is really to have people know you and to know them and to know what they're looking for. All those relationships, it really means, do I and can I garner trust? And trust is the key bond to, I think, our entire industry. When folks are making decisions in the hundreds of millions of dollars, it's certainly not one in which it's taken lightly. And so I came back late last night from New York. It was the second time I've been there in 2 weeks. Not an easy thing to do from Los Angeles, but I felt like it was so important to do that I went back and forth. And so, I would give a little bit of background. Way Capital is a strategic capital advisory firm that represents the entrepreneurial real estate owner and developer in their institutional level capitalization pursuits of their projects. And so, what does that mean? I think Way sits really in a place where, because of our nature of being an independent, to some extent, a boutique capital advisory firm, we can offer a bit more of the white glove service to our clients than you might find elsewhere. And the reason for that is, we essentially own the firm. I own the firm without having to have a split per se with the mothership, which from an economic standpoint means that 100 cents of every dollar goes to every single person that represents our clients. There's no third-party shareholders. There's no outside debt holders of the company. And then what that means is that the clients get much more of personnel and folks that can help them in their initiatives. What does that also mean? My background, as a real estate developer before I became a capital advisor, really can bring some more unique attributes to the table that, others simply just can't, because I spent over a decade as a real estate developer. I went through some challenges in the GFC as a developer, went through bankruptcy myself personally and a company, which was not easy to do, but it taught me a tremendous amount. And for the last now going on 14 years, have really built, I think, a really strong business and representing, folks that were just like me as a developer, meaning that, I had a team of folks doing really cool things, transformative in nature. But the reality was, when I was a developer, I wanted to call more people. I needed to know more folks. And so Way really is kind of the manifestation of what I wanted to have as a developer, which is why I called it Way, which stands for We Are You. And we are just like our clients. And so we're an extension of their team. We are their outsourced CFO. And we go around the country raising capital on behalf of those clients. And but by no faint of heart, you got to put the effort in. But the reward is pretty significant. And even in tough markets, we're very successful. We're good in all markets, but particularly right now when it's difficult, we are more busy than we've ever been. We'll likely have a larger revenue figure this year than I've ever had. which is tough to do in a down market. But the reason for that is that we're good at these more difficult transactions and getting stuff done. So that's a bit of way, and hopefully a little bit about me as well.
No, that's great. And it's, it's funny. It goes back where you and I met, back in '07, and, it is the trust. And it's also with CREDE, we always say we think like owners and we act like owners as owners representatives because we are owners. And it's, that you and I having that common thread between each other is a big deal. You executing, as the outsourced CFO, us executing as a outsourced project delivery group. It's always amazing how many people think we're kind of commodities until it's really time to get dirty and have us do what we really do best. And it's I've always been impressed with how you navigated that.
I mean, look, it's most of our clients, generally the direct connection is the individual that owns the firm, and they're doing $100 million project or $200 million project, $50 million project. They are not. There's a lot of risk on the table for them, and so we don't just look at it and say, hey, does the money show up? Is it the right kind of money? Is it the right type of partner that you'd want to do business with? And you'll hear me always say this, that if you have the phone rings and it's your partner or it's somebody that you're doing business with, and you don't want to answer the call because you're hesitating because you just a personality conflict of some form and you only want to talk to them every other time, that's not the group to do the deal with. So we're in the matchmaking business for sure, not just the money business, but certainly matchmaking.
But tell me a little bit about the team. How big are you now? How many folks, and what do you look for, as your team members?
Yeah, so I would say that we're always fluctuating between 10 to 15 folks. We are in expansion mode at this point. Our belief is that our services are really appropriate from a national perspective. While the firm is headquartered here in Southern California, we currently have offices in Austin, Texas, Phoenix, Arizona, as well as here, with some growth plans to open up an office in Florida as well as New York. One of the reasons for that is we see our ability to provide really this kind of structured finance, white glove service advisory services to developers and owners across the country. And it's a little more difficult and challenging if you don't have a presence on the East Coast and the like. But what we've seen since starting way back in early 2022, I've closed deals now in 15 states. We're currently closing projects in Florida, Georgia, North Carolina, Texas, Arizona, Utah, Colorado, as well as here in California. Is that we think that there's really a need for what we like to call the top of the capital stack, meaning, folks will go call up a capital advisory firm and say, hey, can I get a loan from 0 to 60%, for example? It always kind of bothered me a bit that when I was a developer, I would ask the capital advisor, hey, can you help me go from 60 to 90, or 60 to 100? And if you did, I would reward that with, more assignments for that particular capital advisor. And I found that there were so few that would really spend the time to work on the more difficult part of the capital stack. So in today's market where we've seen, cap rates just, completely skyrocket high, valuations dropping, debt costs doubling, expenses going through the roof, revenues and NOI falling, this is a really difficult time for many people. And understanding how to recapitalize or work on providing services to folks that, requires, having 10 to 15 more people on your team. We're excelling in that because that's how much work it takes. Getting deals closed in this environment is a ton of blocking and tackling and paying attention. I like to say you're crossing T's, you're dotting I's. But I think today's market, everybody's a bit nervous about where things are and where things can go. They spend a lot more time. So we don't just find the capital, right? We actually spend the time to make sure it closes. And I think that's where having resources across the country really help. And honestly, our relationship too, Colby, is huge. I think having CREDE help us with our not really our clients, but our capital groups that we do business with. Providing time efficient, services, being able to say, hey, this is how much construction is remaining, or this is how much, this is what you need to pay attention to, and being able to do that expeditiously is really it's incredibly important to us. So I've loved our personal relationship over all the years, but frankly, from a business perspective, this market, it really is like your eyeballs are on everything, and we're excited about it. I mean, I came back from New York because I did a large dinner on Tuesday night that really had some of the best market makers in the country at that dinner, with all of us talking about how we can provide a lot of the capital that can help developers and owners get through the next 2 to 3 years, either through some new acquisition strategies because assets have fallen to a price that people are looking to buy, or protecting folks and restructuring the existing capital stacks into something that makes more sense with a 5 to 10 year hold versus just buying or acquiring or developing and then selling in today's environment, which you don't necessarily might want to do.
And do you see that, is that, more on certain asset classes or more geographical concentration, or what, coming out of that dinner or people you're talking to, what's the focus for 25 for?
Yeah. So I think one of the things, I mean, obviously we can talk about all the assets, right? So, there is a general consensus in the meetings that I'm going on. We've all been talking about office as just being the worst asset class, been more difficult. It's so difficult. It's just, the valuation perspective has fallen to a level that's never been seen. Frankly, it's so low that many opportunistic investors are certainly looking at office as this is the time to actually look at acquiring office at the right basis, because it is so low that it can't get worse, right? And I think in that sense, you're seeing that level of investment activity potentially coming and growing going forward. Multifamily has been, it got frothy, so to speak, right? So cap rates got incredibly low in 2021. And so what we're dealing with in that asset class is just thinking about, what is the amount of, stabilized NOI or, lease up activity, and how long is it taking, and then ultimately protecting the asset. Because, if you had a 75% loan to cost construction loan that you closed in 2021, here we are in 24, where, interest costs are more than double. Lease up is probably slower than you anticipated. But it's still a nice asset. You're going to need more time. So what are we doing with those? We're restructuring, we're right sizing the debt, bringing in new capital partners to hold it for a much longer term play.
Like a
Yep.
DPO? Okay.
What's that?
So is that like a rescue structure or like a DPO structure?
I like to call that more like just a recapitalization. But yeah, I mean, look, some people like to say you're structuring hope notes and things of that nature. Look, if you're very impaired, and you're going to hear a word that we like to say is that a lot of equity that is invested in deals because of cap rate escalation and value degradation, that a lot of equity that closed in 2018, 2019, 2020, 21. It's just been a really difficult time because we've never seen the likes of a market shift for various reasons, right? COVID was something that put more money into the system than we've ever seen before. We exited COVID and had more money to deploy than we'd ever seen before. So all of that rushed in, and it rushed in quickly. And then immediately in 2022, we started to see interest rate escalation, which then wasn't really identified that this was going to be a long-term scenario. And I think the street would say to you, we're likely to be in a much higher elevated interest rate environment for a much longer period of time than people had anticipated. And I think people are making decisions now either to walk from assets they've invested in, which I call capitulation, which essentially is a strategic decision whereby don't put new money after bad, good after bad. You then work towards the new assets, or because you have an acquisition strategy, those assets are now trading at prices that make sense. And so I think transactional volume will start to increase. And in that regard, we're going to see the new market be pretty active, I think, over the next couple of years. Doesn't change the fact that it's going to be bumpy per se. We're going to be making decisions, everybody, that say, this is going to be a long time for you to protect this equity. Does it make sense Are you taking more risk, or is it sometimes better to put the proverbial keys back to, your capital, your lender, or is it better to work with your lender? In some cases, we're working with lenders to work with our clients to be able to work together because they're so quote unquote upside down that it makes sense for, the borrower didn't do anything wrong. The reality is the market shifted significantly, and so they're still the right provider, and we're working deals so that it makes sense for them to stay in the deal. So it's just all over the place. And then I said geography. Look, the quote unquote tax efficient states are certainly easier to get deals in than the tax inefficient states. And so we're seeing that across the board. But that being said, we're also seeing that the market has shifted in markets like California to a point where I think investors are starting to see some opportunities. The one thing I will say that's been really impactful is that regulation, or where the rules change on the developers or the investors. That is a real difficult thing to get through from an investment perspective, because if you are making a decision to invest and then the rules change on you because the municipality decided to change something, or an election came up and it changed the taxation rules, that is more difficult to get through, and I think that's really impacting value as well. So that's why the tax efficient states seem to be better.
We see that as much with LPs, I don't want to say redlining, but having problems going into certain cities and municipalities, even more than lenders.
Yeah, I mean,
It's their money.
you look at Los Angeles and ULA, which added a 5.5% on gross value tax, which in essence is, if you're lucky, that's a 20 to 30% tax on your equity. If you're in a bad spot, that's just an unbelievable tax affecting everybody in the capital stack. That can be north of 50, 60, 70, 100% of any money that you might get back on an asset. So hopefully municipalities and states will learn that while the thought process is right, let's come up with some solutions for some of the challenges we're facing. But that just seemed misaligned a little bit, that it's not really accomplishing the goal, and it's really hurting overall these communities.
Cool. Well, are you seeing in your business at this point any shift with AI affecting it? We talked really about relationships, where it's going. If we're looking at younger folks that want to get into capital advisory, what advice might you give them?
Yeah, a couple thoughts there. Number one, there's no question in my mind that the best job you can get, this is just a humble opinion, the best job you can get, regardless of comp, is to work at a firm like Way or a firm like ours. It's in the capital advisory world. And I always say, well, they'll go, well, why is that? Well, we see everything. We're doing every asset class, every structure up and down, all geographies. And we are just we see everything, and I think if you're an analyst and you're somebody that's just graduated from college, spend a year to 2 years to 3 years to 4 years, you're going to capture all the market makers, the relationships in our industry. You're going to learn from folks like myself and my peers that are out there, and how deals actually get put together. And I think you're going to learn everything. And I think that's a great place to be. So if it's myself or a larger institutional firm or whatever it may be, I think that's just a great place to be. And then after 3 or 4 years, you figured out, hey, I think I know what I like and where I want to be. At least you've seen everything, so you can know that. When you go work at a firm that doesn't, firms like ours excel in that regard. And so that's one spot. Where I see the world going with AI, there's a couple things. One is there's investment activity that's happening in the world today based upon AI that affects real estate, and that's in the data center hyperscale space. So reality is, what are we doing in that space? We are representing developers in their pursuits of opportunities, either in large scale or in smaller scale. So some in very remote locations that have good access to power and water, and some that are more, in kind of more larger MSAs that are redeveloping land acreage into kind of a data center structure. I had a group that we do business with tell me that I should, have 20% of my business focused on this. And I thought that was a really interesting comment because we hadn't kind of gotten there. And since then, we've kind of grown into that space. So I think that's one area that AI, is going to be there. One aspect is there's not enough power to support the amount of data centers that are going to be needed to kind of power all of this AI infrastructure. So in that sense, I think, and I'm going to lead you with that, Colby, that groups like CREDE are going to be hugely important to finding and being able to work with municipalities and developers to get us the level of power that's needed to support this growth, which I think is going to be significant. The other part of it is, I think, in my business and AI. I mean, look, everybody. I always kind of laugh and chuckle that can an advisory firm be disintermediated by technology? To a certain extent, I think you can disintermediate some levels of more commodity-driven finance. But when it comes to really difficult things that require a human decision, a thought, AI will be there to help support all of those decisions, right? It will help you be faster at making a decision. And in that regard, you're seeing that already happening, but a human is still making the decision. So maybe some more clerical positions will be not as needed. There'll be maybe less positions available for what we like to call grunt work, I suppose, that AI can be faster at. For us, we're certainly using like ChatGPT and the like for our offer memorandum. So we are very fast at creating our own OMs now. I mean, I think we've reduced our speed, from a kind of like a week and a half process to down to 3 days, which has been really exciting. Are we still editing all that information? Absolutely. My sense is, just like everything else, when cell phones came out, when fax machines came out, when computers came out, everybody always said that you'd lose jobs. I think we don't necessarily lose jobs. We're just going to be more moving those jobs in different spots. The one thing that's for sure going to happen is we are going to be much faster. And I think you have to be ready for that, which I think we are. But it's really not going to change the ability to be in front of people and helping them kind of understanding what they're looking at or investing in. And real estate, particularly commercial real estate, is so unique. There's so many different attributes and so many different markets that, I'll find it hard to believe. And maybe somebody in 15 years will look back and laugh at what I'm going to say. But I'll find it hard to believe that you can fully disintermediate, hundreds of millions of dollars of investment down to a computer that makes that decision. I highly doubt it, but maybe I'm wrong.
We agree with you. I mean, the H to H, human to human thing, to me, it's what we do requires so much trust. It's impossible to, in my opinion, it's impossible to separate that. So, before we get ready to sign off today, I really appreciate the time and invite all our listeners to tune in here. But any parting thoughts before we sign off?
No, I just think, look, this is an exciting time for the industry. I think we're going to go through a choppy market here, but I think through choppy markets create probably the greatest opportunity for investment that we've seen since, candidly, you and I met, Colby. I think this is probably on the, if I was to look at the years, we're sitting in 2010, 11, and every deal we put together from 2011 to 2014 just absolutely did incredibly well. So I'm going to predict that if you have the capacity and the capital to invest over the next couple of years, I think that will bear a tremendous amount of returns for you going to the latter part of this decade, candidly, even into the next decade. So good times.
I couldn't agree more. All right, my friend. Well, thank you very much. Talk to you soon.
Thanks, Colby. Take care.